I have come here to chew bubblegum and kick ass, and I'm all out of bubblegum.
This is the Virtual Real Estate Investor Podcast with Vincent Polisi. Buckle your seatbelt and prepare to learn how to legally make six figures investing in real estate with no money, no credit check, and nothing but a computer and internet connection. Learn how you too can begin generating buyers and sellers for free today. And why you're only 2 calls away from making a $10,000 or more payday while never leaving the comfort of your home. And now, your host, the virtual real estate investor, Vincent Polisi.
Hey, what's up, everybody? This is Vincent. Hope you guys are doing well. This is a recording of a Facebook Live and webinar I did a couple of weeks ago based on how to profit from, of all things, taxes, okay, real estate taxation. And this is a very long Facebook Live webinar and podcast because of the degree of information that we covered in it. So what I'm going to do is I'm going to release it all as one consecutive podcast, and then I'm going to go through and I'm going to cut it up into all of the relevant individual sections. As an example, there will be the next sequence of podcasts will all cover one individual tax subject that we cover in this one. So you can absorb it either all at once, or you'll be able to go to and select whichever topic that you want, and it'll be a lot shorter and easier to consume the content because this is a big one. Lots and lots and lots of quality information in this podcast. I highly advise that you listen to it, whether it's all at once, which is kind of like drinking through a fire hose, or if you go through and listen to the individual segments, which will be a lot shorter. There will be a bunch of them because we cover so much material here. But just want to give you guys a heads up. You can, like I said, the next sequence of podcasts after this one will be this actual podcast carved up into individual topics that we cover. So there you have it. Hopefully you enjoy. Yes, I know taxes are boring, but it is a subject that once you understand, it will help you make and or save money, which obviously is always ideal. So there you go.
What we're talking about today is something that is unbelievably important as it relates to not only your real estate knowledge, but as it relates to your ability to do deals and make money, quite frankly. And before we even get into that, let me go ahead and do the introductions here because some of you may not know who everybody is. My name is Vincent Polisi. I'm otherwise known as the virtual real estate investor. On here with me also, we've got Bill Walston, who is a superstar real estate investor who also just happens to be a CPA. So he is actually qualified and licensed to be able to give you tax advice, whereas I am not, even though I know a lot of the same information. I wanted you guys to hear it directly from the source and someone that you can rely on for accurate information as we go through this stuff. Now, taxes play a very big part in, let me rephrase that. They can play a very big part in structuring your real estate deals, okay? And the deal in question that we're talking about, I'm going to give you a backstory of a real owner finance deal that we started this week. And I'll explain to you, I want to tell you guys how this happened because it's unbelievably important, because I know a lot of you struggle to do real estate deals, and it's because, unfortunately, you get a lot of bad information that's out there from these guru courses. Now, I learned, and let me qualify this, the entrepreneurs, okay, and every successful person that I know, they want to fail, okay, and that may not make a lot of sense, but we want to fail fast, and we want to fail often. And that probably seems counterintuitive. And the reason that we want to fail is because those failures, they end up showing us what we did wrong and how to course correct. So back in 2008, when everybody was saying the market was terrible and, the whole housing industry was collapsing and all that, what they were referring to was the retail side that Wall Street reports on, okay, or that Realtor.com, not Realtor.com, the National Association of Realtors reports on. What they report on is they report on retail, okay, one side only. They're reporting on stocks like Toll Brothers and Pulte and whoever the other big builders are that are out there now, nationwide. That's what they're reporting on. Now, there's always, unless you run into a massive depression, and even then, it could be argued that this is the case. There's always a great real estate market, okay? It's just, it kind of evolves and changes. And so when retail was going upside down, okay, and everybody was losing all their equity, and there was pandemonium, the owner finance and creative finance side was absolutely on fire because people were looking for opportunities to actually own a property, even though the banks weren't lending because they were tightening up all the lending restrictions, especially after the design collapse of Lehman Brothers and Bear Stearns, which Bear Stearns was a big mortgage-backed security provider. For those of you who don't know, when all that stuff was going on, they started tightening up the lending restrictions. Right? For those of you that have been in business or in real estate since 2008, you know what I'm talking about. And so I very quickly contracted on more than $40 million in real estate in less than 8 weeks. And this is when I was based out of Atlanta. And, which seems astronomical, right? I mean, it just seems absolutely astronomical. We were contracting on everything from, deals with just individual sellers, deals with realtors, I did deals on entire new construction subdivisions where you had spec builders that had gone out there and they built a bunch of spec houses, and now they couldn't sell them because the banks weren't lending, but they still had to make those construction loan payments to the bank. So they were looking for relief, and they were calling me on the phone crying, and I'm not making fun of them because I lost everything in a very ugly $4.5 million bankruptcy back in 2007. So I had empathy for them, but they were calling me crying because they had to sell their Harley so they could make a construction loan payment, on housing. So we contracted on entire new construction subdivisions. I actually did a deal with a bank called Park Avenue Bank. They were a regional bank out of Florida and Georgia. And we contracted on all of their REO inventory. For those of you who don't know what REO means, REO stands for real estate owned, which means all of their foreclosure inventory. And essentially what they had done was they had foreclosed on the builders, right? Builders couldn't sell the house because the banks weren't lending. And so the bank says, okay, well, we're going to foreclose on you. Well, the banks foreclosed, and then guess what? They can't sell the houses either because they're not lending. And so we ended up entering into an agreement with them to actually do, creative financing deals on all of their REO inventory, which just happened to be, thankfully, all new construction stuff. And essentially what happened was it was a win-win deal because we're off on a little bit of a tangent here, but I want to kind of give you a little bit of a background so you understand what my background is, and then Bill can tell you his. And essentially what ended up happening was we had buyers that couldn't, qualify to finance a cup of coffee at Starbucks that we were getting into brand new $300,000 plus new construction properties. And for those of you who don't know the Atlanta market at that time, $300,000, that was like, 3 sides brick, stainless steel, granite, the whole nine. The works. Real nice house. Okay, it's not like $300,000 in California, if that makes any sense. So these were like real nice houses, $300,000 and up. So it was even higher than that. And all they required at that time was that the buyer / borrower open up an account with the bank, so the account got a new deposit account, which of course they want, and then they had them direct deposit their paychecks into that new checking account, and then they would just sweep the monthly payment for the house on the first of the month. And they were fantastic win-win deals for everything. And then at the end of 12 months, now they had a seasoned, documented, portfolio loan, for lack of a better term, that they could then refinance either into FHA or into their own portfolio. Okay. And so a lot of different, very, crazy creative stuff that's out there. So in this particular deal that we're talking about today, we're going to get into even more than this deal. I want you to understand how this deal came to be. I have a joint venture partner program, and one of my joint venture partners actually did 2 things that most people won't do, and that's why there's a 98 to 99% failure rate in new people getting into real estate investing. Okay. And what he did was, number one, he followed instructions. And number two, he took consistent daily action. And essentially what he ended up doing was, I have a webinar and a podcast called The Power of Eight. And The Power of Eight basically details how you can get free buyer leads with cash from mortgage brokers' dead leads that they can't get financed. Okay. And let me back up for 1 second. So 2008, I contracted on all these properties, $40 million worth of properties, and realized what a logistical nightmare that was. This is what most of you guys do. You go out there and you contract on a property with the hopes of them selling it. Okay. And to me, that's backwards. I used to do the same thing, so I'm not criticizing you. But I learned very quickly what a logistical nightmare that was. And then you have all these sellers that are like, hey, how come my house isn't sold? What's going on? And they want weekly updates. So I'm like, I don't have time for all this. And I quickly realized it was much easier, faster, and more profitable and less time consuming to go buyer first. And I'm not aware of anybody else that teaches buyer first methodology. Typically, they're always telling you to go out there and contract on a house and then shotgun it all over Facebook and, your cash buyer list and all that stuff to try to do a deal. Well, as good as Bill and I are, he and I can go out there and contract on 10 houses and sell none of them. All right. But we go buyer first, we can contract on one property and get paid. So I like that model a lot better than wasting a bunch of time. And so that's how my model evolved and developed over time since 2008, from contracting on a bunch of properties. And oh, yeah, it sounds great. I've contracted on more than 100 million properties over the last 10 years or so. And so anyway, this joint venture partner, again, through the power of eight, what he ended up doing was he's working a full-time job. He's trying to get out of his slave job. And he took it upon himself, had the initiative on his, government mandated 15-minute breaks to follow along with the power of eight, which basically just says, hey, you have a conversation with a mortgage broker and talk to them about their dead leads. Okay. These are leads that they've pre-qualified that can't qualify for financing. And as a mortgage broker in a prior life, I can tell you what happens is they end up in a big stack on the corner of a desk someplace. And nothing ever comes of it because mortgage brokers are looking to make money today, just like we are, right? So that deal that they worked on, they never follow up with them. They never do anything with them. And so the concept is that you can take that dead deal today and you can convert it into an owner finance deal that then the mortgage broker gets to refinance typically in 12 months, okay? So he creates, through working together collectively with you, the mortgage broker will then create a pipeline of future deals that he is going to close, which is genius. It's phenomenal. It's the smart thing to do because that way he's not having to worry about starting from zero every month. He's 12 months out starting a pipeline of deals that are going to close that, we're working on and it's, people think, unfortunately, that on owner finance deals that, people do those because they have bad credit. And then while that can be the case, I will tell you that I would say probably 90% of the deals we do, they don't have anything to do with bad credit at all. It has to do with some reason that they don't qualify for conventional mortgage financing. A lot of times right now it's self-employed people because they're taking, as you'll see here, and Bill can explain as well, every legal tax deduction they can take to minimize their taxable income. And even though they have the ability and the cash flow to make higher payments for the property that they want, on paper, they don't qualify based on a debt to income ratio. Okay. So we get a lot of self-employed people that have perfect credit. They got plenty of cash. They got plenty of cash flow, but they can't go down to Bank of America or Wells Fargo and get a mortgage, but they can own a home through an owner finance deal. We also get a lot of people that they've changed jobs and they don't have 24 months history with the new company. And so even though they've got a 780 credit score and plenty of cash down, the banks turn them down. Well, we can put them in a house. Okay. So anyway, getting back to the JVP, what he did is on his, like I said, his government mandated 15-minute breaks, he started calling mortgage brokers because, it's free. It doesn't cost anything. It's free marketing. The only thing they can do is tell you no. And he explains to them, hey, look, here's who I am and what I do. And I don't know what day it was. It was probably 5 days ago at this point. He talked to the first guy, and the very next day, the mortgage broker referred him buyers with cash. Okay, literally the very next day. And he talked to him, and typically I would talk to him, and then like he explained the whole thing to him and all that stuff. And normally we would do a conference call and all that. And I'm like, well, look, if you've already explained it to him, I'm like, just get him to sign up and let's go. And my sign up process for that is I don't get involved in deals. I don't go out there and look for houses or buy properties for people on contract or anything else unless they stroke out $2,500 up front. Okay. And the reason for that is because I want to make sure that we're dealing with serious people that want to be homeowners, that are not tire kickers. They understand what we're doing, and that's what they're looking for. So he has a conversation with them. They struck out the $2,500. This all happens in 48 hours. Okay. From the time that he spoke with the mortgage broker initially. And as it turns out, they have been living in a property for 3 years, and the property is now listed for sale. So the owner wants to sell the property. Okay. And he likes the people. The people have been there 3 years. They paid on time. There have been no problems. They want to buy the house. I mean, the deal, like, literally couldn't be any better. They're already in the house they want to buy. We don't even have to find them a house. They're already in it. Okay. They've got the cash that we need to do the deal. Owner likes them and wants to sell. And now all that has to happen is somebody has to be able to explain to the owner in, layman's terms, how to put the deal together. Okay. So that's the process that we're in right now. Now I'm going to walk you through some of the questions that he had, and then I'm going to let Bill jump in here and he can explain in greater detail, sort of where we're at, especially based on a lot of his own experiences with people and their misunderstanding and misconception of taxes as it relates to real estate deals. We're going to cover a bunch of different kinds. Okay. So again, quick review, deal info, property, prospective buyer, been tenant the property for 3 years, wants to buy the home, doesn't qualify for conventional financing. Seller has the property listed for sale at $515,000. This is out in Phoenix. And again, I do virtual deals. So I'm in Orlando, Florida. All right. So I'm not ever going to meet these people. I'm not going to go to the house. Don't have to. It's 100% virtual. All I do is talk to them on the phone and send them contracts and get a wire. Okay. Now, the kicker here is that the seller has provided, based on advice, which I personally consider to be very stupid advice from his realtor, already provided the tenant a 30-day notice to vacate, which would be the normal thing that you would do when a lease is ending. So that, from a technicality standpoint, is correct. The problem is that their lease ends December 31st. They're out in Phoenix, and it doesn't give them a great deal of time to find another property, number one. And number two, as the buyer told me, she's called moving companies and is experiencing difficulty with finding a moving company that will physically come out to help them move if they can find a property in time, because they're afraid of the COVID-19. Okay. So we got to, and not only that, we're in the midst of the holiday season. It's just like the worst possible time, if you can imagine, for somebody to have to move. It's the end of the year, holiday time. And then you got movers freaking out about COVID-19 and not wanting to move property. So, I had to explain to the seller, like, look, through no fault of their own, through no desire, through no malintent of their own, they may end up holding over. Okay. So when I got on the call, I had two purposes. Number one was I want to find out if the guy who has a property listed with a realtor, keep that in mind, is open to owner financing. Now, a caveat here, the guy's got almost $200,000 in equity in the property. So if he does a conventional sale, he's going to walk away with $200,000 minus realtor fees, minus closing costs, whatever, in actual cash. Okay. It's not a 1031 exchange. So he's going to take it and he's going to dump it into another property. That's the initial goal. And most people would tell you that what I'm about to tell you is impossible. All right. But I let Bill listen to the phone call so he can verify it. The guy is actually, he's living in an apartment, but he's actually willing, even with $200,000 in equity in the property, to do an owner finance deal. Okay. Which most people will tell you is absolutely insane and like nobody's ever going to do it. Why would they do that? And as I told him personally a couple of days ago, if you get a convention, somebody can come in and they can cash you out. Obviously, that's your deal, right? I mean, that's what I would do as an investor. That's what I would advise you to do versus doing an owner finance deal. But if that doesn't materialize, this could be a good solid plan B. Now, the problem with the 30-day notice to vacate is, again, people don't extrapolate things out so that, they have a full understanding of what's about to happen. Now, this particular guy he's a retired veteran. He's on disability. I don't know what his total income is, the seller I'm talking about. But he's on disability, and obviously he's on a fixed income, and he's very concerned about his expenses, okay, which obviously most retirees are. Because what happens, unfortunately, is when you go to a fixed income, you don't get fixed expenses because cost of things continue to rise, right? You've got inflation, you've got, property, again, in the call, he's talking about property taxes are going up. But of course, on a rental, he can't increase the rent, midstream. He hasn't raised rent on the 3 years, which he should have done every single year, but didn't do that. So he's not keeping up. He's like going, further and further into the hole. Not that he's in the hole, but my point is he's chipping away at his profitability or his net income and his cash flow by not managing the property properly. Now, as a retiree on a fixed income, when that 30-day notice that was filed kicks in and those tenants move out on December 31st, there's no way right now that I'm aware of, if somebody knows more than me, by all means, please tell me, that this thing, unless you have a cash buyer come in, there's no way that this thing is going to close with a conventional mortgage by December 31st with no contract in place at this point. Because number one, no appraisal has been done, there's no title work that's been done, hasn't been submitted to underwriting, and we're about to go into, the back half of the year where pretty much everybody shuts down. So I'm thinking that, the soonest he could, if he got a contract today, close on this thing would be, and I'm not talking about cash where they can close in 7 to 10 days or whatever. I'm talking about if they go down to Wells Fargo or Bank of America, they're closing sometimes the third or fourth week of January at best. So what does that mean for him? What that means for him is on the 1st of January, our, resident hero here gets to eat a $2,000 payment on his fixed income. And the reason for that is because the realtor told him to file the 30-day notice to vacate. Of course, she didn't explain that he's going to get to start making payments on a vacant property, which if you've never done that, it's not a pleasant experience. I've done it, okay? All right? And so anyway, so long story short, I spoke to the seller almost an hour and a half, during which we covered all of the deal metrics, including taxation. Okay, we've already covered this. But one of his big sticking points was that he was concerned about, and I have this in quotes on purpose, losing the tax deduction on the property. Now, the tax deduction that he's talking about, okay, is probably not what you're thinking. It may be, but we're going to cover it here. So the purpose of the webinar is to explain the pros and cons of taxes on owner finance deals versus leases or lease options. And before we cover the pros and cons, it's important to understand the different taxes potentially associated with a real estate deal. All right, so this is where I'm going to let Bill jump in, and let's cover a bunch of the taxes that are associated with real estate. So the first thing that comes to mind for flippers is short-term and long-term capital gains. So Bill, take it away. Can you explain to them the difference between short-term and long-term
Sure.
capital?
Yeah, that's pretty simple. Short-term capital gain is a gain on property held for less than 1 year. Long-term capital gains are investment properties or rental properties of that nature that are held for longer than 1 year.
Okay.
That's the difference.
So,
short-term capital gains are taxed at ordinary tax rates. Long-term capital gains for right now have a much better tax rate. For instance, if you make less than $53,000 and you have capital gains, there is zero tax on those capital gains. And then it goes up to 15%, and the max right now is 20% for long-term capital gains.
Right. But short-term capital gains is ugly. Right?
Pardon? I missed the last part of that.
I said short-term capital gains is pretty ugly, though, right?
Oh, short-term capital gains can be pretty ugly because it's taxed at ordinary income rates.
Yeah. So
Even though it's a capital gain, there's no special taxation on short-term capital gains.
Yeah. Okay. And you just touched on something that I wasn't even aware of. So on long-term capital gains, that's 366 days or more that you've held the property. The first 53,000 is not taxed.
No. If your total income is less than 53,000.
Oh, your income is less than 53,000.
Right.
Okay.
Then there is no tax on the capital gain. If your income is 54,000 to about 470,000, your tax rate is about 15%. And then if your income is over 470, you're hit at 20%. So quite honestly, a lot of people are usually in that 15% range.
Right. So this would be
for capital gains right now. Yeah. And unfortunately, that may not be around very long because there are talks of capital gains going back up to 50% or more.
Yeah, I'm not to get political, but if I recall correctly, I thought one of Biden's talking points was that he was going to get rid of capital gains altogether.
Correct. And the offset to that is people said, oh, no, let's keep them, but they're at 50%. But, Vincent, I can remember when capital gains were taxed at 50%. So that's nothing new. Everybody thinks that that's a new thing, and it's not. No. Remember, I've been in this game for over 3 decades. Yeah. So when I was first started doing taxes, capital gains were taxed at like 50%. So there is that.
Wow.
So basically, guys, what you want are long-term capital gains, if you can get them.
For sure. All right. Somebody on Facebook said they can't hear Bill if they're supposed to. Can you guys hear Bill now if you're on Facebook Live? Let's make sure
that you can
hear Bill. Can you hear me now? If you guys can hear Bill, please let us know. Leave a comment on Facebook Live. Or if you're on GoToWebinar or whatever.
They may have to catch me on the replay. I'm not sure what's going on with that.
Yeah, well, like I said, sometimes these things don't play well together. Okay, so next up, capital gains exclusions for single and married couples. Now,
and
go ahead.
I'm assuming you're talking about the sale of a personal residence?
Correct.
Okay. All right, so if you're selling a personal residence, your capital gains exclusion is $250,000 if you are single, and it is $500,000 if you are married filing jointly.
Right. And so, as it applies to this particular deal, unfortunately for our resident hero here, he only lived in the property one of the last 5 years. So if he were to do the conventional sale with the realtor, he's going to get whacked for the 6% realtor fee plus his closing costs plus the whatever his capital gain is, I guess, at that point, because he doesn't get the exclusion. So
right, and didn't you figure that his capital gain was about $200,000?
Yeah, well, it's I don't know what his basis is, but that's what we're estimating. Because I don't think he's done
and if you estimated a $200,000, he's going to be taxed at 15% on that capital gain.
Yeah, okay.
And he cannot exclude it.
Yeah, and he's very sensitive, obviously, about profitability. I mean, being a retired individual, I'm sure you can appreciate that. Very, very sensitive about that. Okay. Owner occupant property tax and mortgage interest deduction. So let's talk about that for a second.
All righty. You can, if you own a property, right? It is your primary residence, and I'm assuming that's what we're talking about here because it's owner occupant property. There is a deduction for mortgage interest, and there is a deduction for property taxes. Those are a couple of the still allowed itemized deductions because the Tax and Jobs Cut Act almost eliminated anything else as a itemized deduction. Right now, you've got charitable deductions, medical expenses, mortgage interest, and property taxes. And those are the only 4 itemized deductions that you can have right now. Most people, it's estimated now that maybe 95% of U.S. taxpayers don't even claim itemized deductions anymore. But if you are one that can, then you can get the mortgage interest deduction. That comes off the top. The problem with that, and it doesn't affect a lot of taxpayers, but you can only take interest on the first $750,000 of principal.
Yeah.
So if your mortgage is more than $750,000, you're not going to be able to take any interest on that excess. And people who are making $750,000 or less, honestly, they are the ones who fall into the category. They're probably not claiming these either. And also on property taxes, that's capped at $10,000. So regardless of the amount of property taxes that you pay, the most that you can take in sales and local taxes and property taxes combined is $10,000.
Wow. Yeah, and just as a reference, until I can't remember what year they just recently changed this, but it used to be that you could deduct mortgage interest on a primary and secondary residence with combined loan amounts up to 1.2 million, and they whacked that down to 750.
Right.
Do they still have it on the secondary residence, or is it only on primary now?
No, you can still take mortgage interest on a secondary residence. And a lot of people are confused too on a HELOC. They think just because they have a HELOC that they can deduct that interest. You can't. Right. It depends on what that interest is used for. So if you take out an equity line of credit, in order to be able to deduct that interest, you have to spend that money on improvements on the house. You can't use it for anything else. If you do, I mean, you can take as much equity interest as you want to, HELOC as you want to, but you can't deduct the interest on it unless you spend it on property renovations.
But everybody does it anyway.
Oh, sure they do. But it's just like anything else, it's like when I talk with my clients about how do I not be classified as a dealer? Well, the best way is never get audited, because that's the only time you're ever going to get classified. So this is the same way. Deduct your HELOC interest, and if you get audited, they'll disallow it.
Yeah, this is like speeding is not illegal until you get caught. So
till you see the blue lights, buddy. Till you see the blue lights.
All right, property taxes. Okay. Another form of taxation on real estate. We kind of just covered that a little bit with the owner occupancy thing. Anything for you to add specifically?
Well, the only thing, the difference between property taxes on rental properties and investment property and property taxes on residential property taxes on rental properties are not capped. So if you own rental property, you can take the property taxes as a deduction against your rental income, and there is no cap on it.
Gotcha. Okay. Because it's an expense. All right. Expense deductions on rentals.
Okay.
And there are a lot of them, or there can be.
There can be, especially if you have a creative accountant. Did that go out public? Yes. Okay. Never mind.
Yeah. All right. So this is another thing. And what we're referring to here, I'm actually about to show you the Schedule E in a second, so you'll understand what we're referring to. Expense deductions on rentals. This is actually what the seller was concerned about. He was concerned about losing, okay, because again, he's not extrapolating this thing out, losing his tax write-off, what he considered to be his tax write-off on the property if he converted from a rental to an owner finance deal. And what he's talking about in reality, translated, he's talking about the expense deduction on the rental, which he would no longer have. He would no longer have the expenses because those would all be transferred over to the buyer.
Correct.
So there would be no actual loss for him. It's actually a bonus, and we'll cover that in a second as well as to why it's actually better for him from a financial perspective. All right. Next up, depreciation.
Okay. Depreciation is actually a tax write-off. It's kind of interesting. We don't pay out depreciation expense, even though as rental property owners, we can claim depreciation. What we're actually doing is recovering some of the cost of the property itself. So it's basically just tax write-off. For residential properties, it's 27.5 years. For commercial property, such as storage buildings, strip malls, that type of thing, is 39 years that you recover the cost.
And talk about recapture.
Recapture is if you sell that rental property and you have taken depreciation expense on that property, a portion of the gain on that property is considered recapture of depreciation. So up to the amount of the depreciation allowed or allowable, okay, that's considered a depreciation recapture, and it can be taxed up to 25%, that portion of the gain. Now, here's something interesting, Vincent. We'll get to it a little bit later, I'm sure, because we're going to talk about installment sales. Everybody worries about depreciation recapture, and it's, oh my Lord, I can't sell my property because of depreciation recapture, right? Well, what they don't realize is that the installment sale method will also defer that depreciation recapture over the life of the loan.
Wow, okay.
So it is not, everybody thinks it's all recaptured in the year of the sale, and that is not necessarily true because some accountants don't know how to handle this.
Gotcha. All right. So are you able, if you can do this, I don't know, maybe you can't, but if you can do it, can you break this down into actual real numbers for me on depreciation? So as an example of what the recapture would be. So if, you have a property at X and you sell it at Y.
All right. So let's say that you bought a property for $300,000.
Okay.
Okay. And you've depreciated that property by $200,000.
Okay.
All right. So the basis of the property is $100,000. All right. So when you sell that property and you look at the gain on that property, give me a figure that you want to sell it for. 500? That work?
Yeah. Let's say 500,000.
All right. So let's say you sold it for $500,000. Well, the basis is $100,000, which leaves you a $400,000 gain. Okay.
Yeah.
So that gain is actually split into two forms. It's all capital gain, but the first $200,000 of it, since we took $200,000 of depreciation expense, the first $200,000 of that gain is recaptured at the 25% rate. And the remaining $200,000 is recaptured at whatever the capital gains rate is for that particular taxpayer.
Wow.
Okay.
So you pretty much have to have an abacus and a protractor to figure this out, huh?
Yeah, pretty much. But that's what people worry about when they're talking about recapture, depreciation recapture. What they're concerned with is of the gain, the first part of that gain up to the amount of the depreciation allowed is taxed at a higher rate than the rest of the gain would be. So if you've got $200,000 of depreciation and $400,000 of gain, the first $200,000 of that gain would be taxed at 25%, which is the recapture rate. And then the remaining $200,000 would be taxed at whatever capital gains rate that particular individual is at. But I see where they're coming from, because nobody wants to pay that extra 5%. Right, of taxes.
Sure.
Okay, but it's not as bad as people think it is, because it's not taxed at an ordinary income rate, which can be as high as 39%. It's not taxed at ordinary rates. It's taxed at the maximum rate of 25%.
Right. You just touched on something that I don't think most people take into consideration as it relates to, and unfortunately, I don't think a lot of people know what basis on a property is. But the basis being reduced because of the depreciation, then causing potentially higher capital gains. Oh
yeah, it will definitely cause higher capital gains.
Right.
Because the basis of the property is not its actual cost. It's its cost less. Well, actually, it's the cost plus any improvements less any allowed or allowable depreciation. And the other point in that is, notice it says allowed or allowable, because some people will rent property out and they don't take depreciation because they don't understand the concept, right? They do their own taxes or something like that. They've not taken any depreciation expense on that property. IRS doesn't care. That's why they have the word allowable in there, because what they say is you would be allowed a certain amount of depreciation whether you took it or not, and we're just going to assume that you did, and that's how we're going to compute the gain on the sale of the property.
Always pleasant.
Yeah.
when they determine how to tax you, even though you didn't do it that way.
Right. And one thing I'll throw out about the depreciation recapture, I don't think I mentioned it. It is treated as taxed as ordinary income, right? So if your income tax rates are lower than 25%, then it would be taxed at the lower rate. If it's higher than 25%, it's capped at 25%. But let your accountant figure that out. That's what they're for.
For sure. All right, cost segregation. A lot of people don't even know what this is. So
I love cost segregation.
Yeah. Well, hit them with it. Tell them how it works.
All right, but basically, cost segregation is used for rental properties. It can be used on any type of commercial property, anything like that. But essentially, what it does, remember I said depreciation for residential property is 27.5 years. Right. Commercial property, it's 39 years. Okay, well, there are some components such as furniture and fixtures and things like that are not necessarily a part of the property itself, and those are written off at much faster rates. They're classified as either 5-year property, 7-year property, or 15-year property. Okay, what Internal Revenue Service has done under cost segregation is they actually allow parts of what some people would consider to be the property itself to be written off faster. And by that, I mean cabinets, okay, walls that are movable walls. And in some commercial properties, you have movable walls, so you can increase or decrease the size of spaces. Those can be written off in 5 years. Carpet can be accelerated. And so essentially, if you have a cost segregation study done, the people who are doing that study will break down different components of the building, like plumbing, fixtures, those types of things, and they'll reclassify what they can legally to either 5 or 15-year property. And under the new tax laws, which are going to expire down the line in some way, form, or fashion, but under the law that exists right now, you can write off 100% of those items under bonus depreciation rules. So let's say that.
I'm sorry. Go ahead.
So let's say that you got a cost of a building. Your purchase price of that building is $400,000. And somebody does a cost segregation study and pulls out 100,000 of that and classifies it as trees and shrubbery and sidewalks and plumbing and carpet and whatever. It reclassifies those items to either 5 or 15-year property. That $100,000 is written all off in the first year.
And you just touched on the point I was trying to get to, and this is very important for you guys to understand, is that when you're analyzing a deal, if cost segregation can be utilized, you can take a deal that everybody else is looking at as a non-deal and turn it into a cash flowing deal through this method. Is that not correct, Bill?
That is absolutely correct. One thing, though, that you got to remember is cost segregation also factors into depreciation recapture. Okay. So if you're not planning on holding these items for a certain period of time, and if you're going to do a quick sale in 5 years or so like that, it probably would not behoove you to take cost segregation, right? Because you'd have to recapture all of that back as ordinary gain.
So this will tie right into when we get into opportunity zones here in a second.
Right.
So, because that would
be
absolutely perfect for that.
Yep. Well, the whole thing would be a factor if you look at 1031s and opportunity zones. But for cash flow purposes, it's great.
So I want to recover that just so everybody understands. All right. So you can have a deal out there, okay, and everybody else can tell you that it's not a deal because it's not cash flowing. And through cost segregation, there's a cost segregation study that's done, and it adjusts the taxes, and you could turn that into an immediately profitable deal that nobody else sees. Okay, these are strategies that most of the time are not taught by most people because, quite frankly, most people don't even know about them. But that being said, this is why it's important to do your due diligence and obviously be, how you say it, a perpetual student, okay, of your craft so you understand what can and can't be done. Because, there's deals out there that you guys could be doing where everybody's passing on them. It's like cap rates. Okay. That's a whole other topic of conversation. People get all hung up on a cap rate, and I'm like,
Yep.
okay, I don't even look at the cap rate. Let me see what the numbers are. Or let's see what else is going on, and how they calculate the cap rate to begin with, because most of the time it's bogus anyway, just like a pro forma. But nonetheless, all right. So cost segregation, fantastic opportunity to take, number one, something that wasn't a deal and turn it into a deal, a cash flowing deal immediately. And number two, we'll get into opportunities and other thing here, and I'll let Bill expand on that so you guys can understand that. All right, next up, homestead exemptions.
Okay, homestead exemptions are interesting because it depends on what state you're living in as to what a homestead exemption is. I know in Florida they have a homestead exemption which reduces property taxes, correct?
Correct. Yep.
All right. Tennessee does not have that. Okay. Tennessee does have a homestead exemption, but the homestead exemption in Tennessee refers to the amount of equity that you can exclude from a bankruptcy. Okay, so they have entirely different meanings depending on where you live. So in Tennessee, we don't get a reduction for our property taxes just because we live in a property. But if we ever filed a bankruptcy, we could retain part of our equity in the property, if that makes sense.
You could, okay, hold on, back up. If you file bankruptcy, you could retain equity.
In other words, you would have a certain amount of equity protected in your property. Is all that is. You can exclude that from a bankruptcy filing.
Does that assume a foreclosure sale and you're getting paid from that, or are you talking about if you include the house in the bankruptcy?
If you include the house in the bankruptcy. Okay, wow. And that amount is protected from creditors up to $70, and it's only like $7,500.
Oh, okay, gotcha.
So it depends on where you live as to what a homestead exemption actually means. Okay, so you guys in Florida, when you hear homestead exemption, it reduces your property taxes like crazy. Here in Tennessee, a homestead exemption has no effect on property taxes. So it just depends on where you live.
And I just learned something. See, I didn't know that. That's why I love doing these with you. I had no idea that homestead exemptions weren't the same nationwide.
Nope.
Well, there you go. All right. What's called the SALT deduction, and SALT stands for, Bill mentioned this earlier, state and local taxes.
Yep. And we actually covered that a bit earlier. It's just the combination of your state and local taxes and your property taxes as a deduction for tax purposes as a homeowner is capped at $10,000. And again, there's no cap if it's a rental property.
No cap if it's a rental property. Okay. All right. Safe harbor for qualified business income. Most people probably have no idea what this is.
Okay, qualified business income refers to that 20% pass-through deduction that a lot of people aren't even aware of. It's called the 199A deduction, and it essentially says that if you have a pass-through business, and that's a Schedule C, it is a sole proprietorship, it is which is a Schedule C, a partnership K1, or a sub S corporation K1, that you have a deduction of up to 20% of that money is excluded from taxes. Okay. Now, there was a question with Internal Revenue Service as to whether rental properties were classified as a trade or business, because the law reads that it's trade or business income. And rental properties in some cases are not considered trade or business. So the IRS came up with what they called a safe harbor, which said if you've met certain qualifications, you could take that 20% pass-through deduction against your rental income. And the safe harbor is 250 hours that you have to work on your rental properties. All right, that's roughly 4.8 hours a week. Okay. That said, those hours have to be maintenance, repairs, rent collection, showing the property, things like that. has to be 5 hours a week. Honestly, it's just like the 750-hour rule for real estate professional. Sometimes it's hard to show. I mean, it's hard to make it qualify. All right. But if you can use that 20% rule for excluding income.
You'd have to pretty much be a very proactive property manager.
You would have to manage your own properties, and Bill don't do that. So unfortunately, Bill does not qualify on the basis of rental income to get that 20% deduction. All right, and the other thing too, triple net leases do not qualify. Okay. All right, so if you've got your property out on a triple net lease, which is
slow down. You better explain to them what a triple net lease is, because a lot of people don't know what that means.
All right, triple net lease is when you almost defer everything over to the lessee, where they're paying the taxes, they're paying the insurance, and they're doing all the repairs and maintenance type stuff. Where it's kind of hands off, and all you're doing is collecting rent on the property. Yeah. And if you have a property out on triple net lease, then you don't even qualify for safe harbor, period.
Gotcha. But at the same time, you're deferring. I mean, triple net's probably the best type of lease there is, from the standpoint of all you do is collect the check, and they're taking care of the common area maintenance.
That's right.
And, it's called CAM and all the other things associated with the property. So, all right, very interesting. All right, there we go. All right, next up, let's see what we got. 1031 exchanges. I'm sure most people have heard these. What do you? I'll tell you what. Tell me your thoughts on this. And I'm gonna pose two questions to you here. Number one is, I'm gonna play devil's advocate here. One is, are you or are you not a fan of 1031 exchanges? Because my argument would be that you are kicking the can down the road to a potentially higher tax bracket, because
Correct.
You can obviously foresee what the tax rate will be at the time you cash out.
Okay, and here's the thing, and I hear that argument a lot. 1031 exchange, everybody talks about, how do I get around capital gains? You don't get around capital gains in most cases. There are a few exceptions, but in most cases, I just get amused at people saying, how can I get around capital gains? And everybody says, oh, a 1031 exchange. You don't get around capital gains by using a 1031 exchange. A 1031 exchange is simply deferring the capital gains. Okay? But as I have always said, in tax rules, what you do is you defer, and die. All right. So you can kick the can down the road far enough and long enough that you don't have to worry about it anyway.
Okay.
So that would be my answer to that. I am a fan of 1031 exchanges.
Okay. All right. So second question then would be, and I heard this years ago, so clarify this for me, because some of the people were selling courses on this, that you could 1031, for, let's say, 30 years until you're retired, and then somehow avoid the capital gain by turning or rolling that money into a primary residence for yourself. Or the other thing that they were pitching was that there was some way that it could be converted over from a legacy planning standpoint into, I don't know if it's a trust or something else for your heirs without the capital gain being taxed. I
would have to look at what they are talking about. Okay. I have heard, I know that you can roll some of your 1031 exchange into a personal residence, but it'd have to be a hell of a big personal residence to be able to. I mean, if you've deferred long enough that capital gain, you know what I'm saying? I don't know of very many situations in where that would be plausible. I'm not going to say it can't be done. I would have to study and review what the trust is talking about. Okay, because in my experience, capital gains can get deferred, but if you leave it to your heirs, they're going to have to pay on it at some point in time. Excuse me. Unless they're thinking about the situation where you die, right? And the heirs get stepped up basis. And there are some circumstances where that might happen.
Right. For those of you who don't know what a 1031 exchange is, basically what it is it's very simple. You have a property, let's say, like in this example here on this deal that we're talking about, the guy's got $200,000 in equity in the property. If he sells it, then instead of taking the hit today on the capital gain, he can defer that by rolling that capital gain into another like kind property. Okay.
Right.
In other words, he's going to turn it into another investment property at that point, and then he's not taxed. And so the theory or the concept is that it gives you greater leverage because you're not taking the what's the top hit on capital gain?
The 20%.
Yeah. Okay. So in other words, it's basically like getting an additional 20%, leverage that you can then pour into another property for, hopefully potentially greater profit down the road. That's
Sure.
the concept. And then
that's the concept. It can only be done on rental properties now, right? At one time, 1031 exchanges could be done on just about any type of business property. Okay, if you exchanged automobiles.
Mm-hmm.
And you sold an automobile and you invested that money into a new automobile for your business, you could do a 1031 exchange. It could be treated as a 1031 exchange. Nothing like that exists now. The only type of property you can do a 1031 exchange on is real property, rental properties, or not necessarily rental, but real property, right?
Okay, so storage units.
Storage units, you could do a 1031 exchange. And what's interesting too, you could go from storage units to apartment complexes, because all real property is considered like kind. So it doesn't have to go from storage property to storage property. It can go from storage property to multifamily units to strip mall, whatever. Okay. Right? Really? So that's kind of interesting. A lot of people don't realize that like kind is just another real estate investment. The one thing that I don't necessarily like about 1031 exchanges is all the proceeds from the sale have to be reinvested. You can't keep any of that money at all. So even the part that is not considered gain, you don't get to keep and use. All the proceeds have to be given to a qualified intermediary who holds that money until you get ready to close on the new property, which incidentally has to be within 180 days.
Right. 45 to identify and then
45 days to identify and 180 to close.
All right. Let me ask you this, because this question comes up all the time. So, is it crazy? And the laws obviously change all the time, so you're obviously more up on this than I am. But so if I sell, let's say, I sell $1 million house with rental property, and I've got $800,000 in a capital gain. Can that then be used to buy, let's say, 8 other $100,000 houses in the capital gain?
Yes.
So you can
actually, it couldn't be $800,000 houses, because you've got to roll over. The property has to be valued at least what the relinquished property is valued at. So generally, all right, now this is a rough rule of thumb. It can be done a little differently, but generally you would take a look and look at sales price, right, of the property going out, and the new property has to be of equal or greater value.
Got it. All right, just want to clarify.
But yes, I think you were getting to the point is, does it have to be one property or can it be multiple properties? Right. And it actually can be multiple properties as long as the total value of all the properties added together is equal to or greater than the relinquished property.
Okay, so they could be, so 800,000 rolled over into 8 $100,000 homes, that would work. Is that correct?
Offhand, I would say those homes would have to value at least $1 million or more.
$1 million. Okay, I got you. because that's the value. That would have been the value.
Because that
of
was
the
the
property.
value of
So,
what you
got it.
relinquished. Now, there were some,
Okay.
I mean, every case is a little different. You have to look at each individual one, but the rough rule of thumb is the houses that you acquire in a 1031 exchange must be of equal or greater value than the relinquished property. So if the relinquished property is worth $1 million, then your new package has to be worth $1 million.
Gotcha. Okay. You know, do something here real quick. Bear with me. I think. Okay. All right. So next up, opportunity zones. This just came out, what, last year? 2019?
Yeah, with the new tax act. Yeah.
Right. Okay.
And people just
So-
started using them probably in 2019, maybe late 2018.
Okay. And so explain, if you would, an opportunity with the benefits of an opportunity. It's essentially regentrification of, as I understand it, maybe I'm incorrect, but regentrification of a distressed area that you then hold for, what is it, a minimum of 5 years, I believe?
Yeah,
right?
they like for it to be at least 5 years. Doesn't
Okay.
have to be at least
And-
5 years, but they want it to be at least 5 years. Basically, it is there are designated areas all across the United States that are designated as opportunity zones, and they were made to incentivize investing in low or undercapitalized areas. So the governors of each of the states get to nominate opportunity zones from their state, and then the Treasury Department decides which ones are opportunity zones. And those that are designated as opportunity zones, if you invest in those zones, right? Let's say you sell a property and you invest the proceeds or the capital gains into that opportunity zone, those capital gains are not taxed until 2026 or until you sell the property. Okay. Now, if you leave that investment in that zone for a certain period of time, the basis increases at 5 years and 7 years. So as the basis increases, and I think they said at 5 years you can increase your basis by 10%. At 7 years you can increase your basis by 15%. And then if you leave that investment in the opportunity zone for a minimum of 10 years, you aren't taxed on any capital gains. So the capital gains you invested into the property and any earnings, any increase in value of that property, none of that is taxed when you sell that property if you left it in the opportunity zone for at least 10 years.
So theoretically, that could be a fantastic deal.
Sure.
Okay. All right. So getting back to the deal at hand, I think we've covered just about everything we can cover as it relates to taxes on real estate. But this particular deal, like we're talking about, we get back to this, the seller was concerned about, quote unquote, losing, and this is on the owner finance deal, his tax deduction on the property. All right. Now, what he really meant was that he was concerned about not being able to write down or write off expenses. This is what he's talking about. This is what he's referring to right here. This, for those of you who don't know, is what's called a Schedule E, and this is where you're going to itemize out all of the expenses associated with a rental property, okay? And so being on a fixed income, having taxes go up, having insurance go up, all of these things, he was concerned about losing his ability to write off these expenses. Now, where the problem came in was that he wasn't realizing that he would no longer have any of these expenses to write off, because under the IRS installment sales contract guidelines, it's IRS Pub 537, the new buyer coming in, they must take over any and all associated expenses with the property, just as if they were the actual quote unquote homeowner, which they technically become on paper, whether it's a contract for deed or subject to, or however you structure your land contract, whatever. They technically are the owner, whether they have the deed or not, and they can get homeowners insurance, and they can qualify for homestead exemptions. They can they have all the benefits of homeownership, but in order for them to qualify, this is very important. In order for them to legally qualify on an owner finance deal, for them to be able to write off, I'm talking about the buyer now, the borrower, in order for them to be able to write off the mortgage interest that they're paying and the property taxes, as Bill covered earlier, they have to handle everything associated with the property. In other words, the seller can't handle maintenance and repairs. Okay. So they have to handle everything just as if they own the property in order to qualify for that deduction. Otherwise, they're not classified as a quote unquote homeowner in the eyes of the IRS. And so this is one of the reasons why it's really important to understand the pros and cons of how these things work, because this could have easily been a deal killer on a fantastic deal. All right. And I didn't cover what the revenue on this thing would be, but, we're looking at pulling about $37,000 off of a couple of phone calls, simply for putting this deal together. And if you don't have an understanding of, what's going on and what people are really talking about, especially when you get involved in a tax situation. And that's why, Bill is a fantastic resource. And of course, he's all over Facebook and answers questions and that kind of thing. So I would absolutely reach out to him. And when we get done, you need to definitely tell him about your mastermind coming up in January. But let me explain this to you guys. If you haven't done enough deals, I gotta, we have a retiree, so he's an older guy. So I gotta take things slow. I really want somebody else involved in the transaction on his behalf. Honestly, I would never, you never want to have a third party involved, but because of his age and that kind of thing, I really want to get, a CPA or an attorney involved for him to explain things to him on his behalf, because otherwise you can put yourself in a position where you, as a real estate investor, in the eyes of the court, appear to be, just like realtors, you appear to be the expert, okay? And it's very easy to put yourself in a position where the perception is that you took advantage of someone, okay? So you take advantage of an elderly guy because he doesn't understand blah. I don't want anything to do with any of that stuff, okay? So that's why I told the guy, look, if I'm happy to talk to your attorney, I'm happy to talk to your CPA, I'm happy to have this conversation with your attorney, and he can draft all the documents. We don't need to use mine. I can bullet point out exactly everything that we're going to do and how it works, all those things, because I don't want that liability of, the whole thing coming back because he doesn't have an understanding, right? He really needs representation in this particular case because it's not his forte. And he even mentioned he's not a businessman, which is one of the reasons why he hasn't raised a rent on the people in the last 3 years, okay? But this one little thing could have been an absolute deal killer, because here he's afraid he's going to lose a tax deduction, not realizing, okay, that he would no longer have any of those expenses to write off, number one, not realizing the upside potential because now we're going to get him a higher monthly payment and higher net cash flow, number two, not realizing that he's going to be able to eliminate his homeowner's insurance policy on the property, which also, again, effectively increases his net income because he doesn't have to pay for an insurance policy anymore, right? And so it's like a combination of all these things that have to be explained so he understands how and why he's coming out better. And I didn't even cover this yet, but also he's not having to pay for or deal with maintenance and repairs, which if any of you have ever been landlords before, you know how fun and exciting and expensive that can be. So from a standpoint of which deal is the better deal for him to continue being a landlord or to roll into an owner finance deal where basically everything is taken off of him and he cash flows more money, and ideally within 12 months then he's able to get his $200,000 out and move on down the road, which he's not successfully been able to do in the last 3 years, then it becomes a much better deal. But you have to be able to explain that stuff to people, and you have to understand, like, he's concerned about a tax write-off, that it's a moot point, okay? It doesn't matter that he won't have that tax write-off anymore because he also won't have the expenses to go along with it. Hopefully that makes sense to you guys, okay? Plus all these other things like we're talking about not having to pay for maintenance and repairs, higher rent, not rent, I'm sorry, wrong term, higher monthly payments coming in because it would be a mortgage payment, it'd be classified as a mortgage payment at that point. As well as, he was complaining about tax increases in property insurance increases. Well, that all gets deferred over to the buyers. So it's a win. I mean, it's like a grand slam home run for him. If he can't sell outright, if he get his cash out today, this is a grand slam home run for him over what he's got right now. But it has to be explained to him in, very simple terms as to what all of the benefits are of this type of transaction. That's one of the reasons why, I went through what I went through with him, and explained, how the contracts work, how the IRS views everything, and that the buyer has to cover all the expenses associated with the property. And this is another hard concept for people to understand. If you guys have ever done owner finance deals, you'll hear all these commingling of terms because people don't understand what's actually happening and transpiring. And I had to explain to him that he was moving from landlord, okay, which is what he is now, to lender, and that the tenant was moving from tenant to owner and mortgagor at that point, okay? And, he's thinking about what he's been doing for the last 3 years, which is, okay, landlord, tenant, I get a payment, that whole thing, right? And then the question regarding capital gains comes up. And like I said earlier, you'd only lived in the property 1 of the last 5 years, not 2. Under our IRS guidelines, if you've lived in the property 2 of the last 5 years, and I don't even have to be consecutive years, but 2 of the last 5 years, his $200,000 gain would be tax-free. You wouldn't even have to pay it, but he only lived in it 1, unfortunately. Okay. Now, this is another thing, too. I also had to explain the complexity to a retiree, all right, that his capital gains will be based on his basis in the property and would only be taxed incrementally with a portion of each payment made by the buyer rather than all up front when we executed the contract. Now, I'm going to have Bill jump in here and help break this down so you guys can understand. So first and foremost, if you don't understand what basis in the property is, basis in the property is basically, what you paid for the property plus any additional improvements in the property. And then Bill's going to come in and say, minus your depreciation.
Minus depreciation. Yep.
Right. Minus depreciation. Okay. So, understand that if you bought a property for $400,000, when we're talking about capital gains, and you sell it for $500,000, and you're thinking, okay, I have $100,000 capital gain, but you did $50,000 worth of upgrades to the property, and you've got your receipts and all that. Well, you only have a $50,000 gain because you have a step up in basis based on the improvements that you did to the property. Okay, so these are very important things to understand when you're trying to work a deal out. Because I don't know, he may or may not have a $200,000 capital gain. I don't know what he's done to the property. I didn't get the sense that there was a lot of improvements done, if that makes sense. The house looks great, but I didn't get the sense there were a lot of improvements that had been done. All right. Now the next thing is, and Bill can probably explain this to you a lot better than I can, but because this gets very confusing for a lot of people. All right, so we're doing an owner finance deal that's in compliance with the IRS installment sales contract guidelines. Now, on the day that we execute the contract, that's the date of sale. So if we execute the contract this afternoon, effectively, the property is sold at that point, okay? Which means capital gains is due in a normal scenario. But, and this is the thing that a lot of people get concerned about, is does that mean that he's going to have to pay capital gains today, okay, or on his next, quarterly return? I don't know how he's filing his taxes or whatever. But on his next tax return, he's going to have to pay the capital gain of $200,000, even though he hasn't realized the $200,000 yet, because if we have an effective sale today. I will let Bill take it from here.
Okay. So effectively, if the sale took place today and you did not do an installment sale, which I'm sure that's what you're leading to, the capital gains would be that gain on sale would be reported for your 2020 taxes or for his 2020 taxes. And it would all be reported at one time. and he would have to pay those capital gains when he filed his tax return in 2021. Okay.
On an installment sale.
Okay. On an installment sale, what will happen is basically the way I explained it to someone who really doesn't know what an installment sale is that the capital gain is spread out over the life of the loan, is how I explain it.
Yeah.
So in other words,
and
see guys, and when you're talking about some of this, okay, I know Vince and I went into a lot of stuff and said, this is what it does to your tax return, things like that. That's so that you will understand the concepts that you have to talk about, not that you need to tell these people this is what it's going to do to your tax return. Okay. So the way I explain an installment sale, you guys know that, and Vincent has already said, we take a percentage of the gain, we pay the taxes on that percentage of the gain, capital gains rates applies to this amount, blah, blah, blah. But when I explain installment sale to my potential seller, what I tell him is if you sold conventionally with a realtor, when you sell this property, all of the capital gains are due and taxable in the year that you make the sale because you're receiving all the sale up front. If you do owner financing and you can report that as an installment sale, and that capital gain is spread out over the life of the loan. And they can tell, all right, which do I want? Capital gains all in 1 year or capital gains spread out over the life of the loan? So that's how I essentially explain an installment sale.
Right. Very, very, very simple. But again, most people don't know that.
Correct.
And, you can lose a deal because a seller thinks he's going to get whacked with.
Oh yeah, they hear they hear capital gains and they immediately, oh my God, if I sell this property, I'm going to have to pay this much, and they think to themselves, where am I going to get the money to pay it? Type thing.
Right. Exactly.
When you explain to them, hey, you don't have to worry about that, or where the money comes from if you use an installment sale.
Right. And essentially, it's being paid for by the buyer anyway.
That's absolutely correct, as it goes along. Yep.
Right. So at this point in the conversation, it became clear that what I needed personally, and in fact, all of us needed, was a simple infographic breakdown of the benefits, pros, and cons of seller financing versus leases and or lease options or whatever. And so we're going to put that together and provide it to you guys so that you will be able to easily communicate this information to your sellers as well as your buyers, because there's pros and cons on both sides. When you're looking at doing owner finance transactions, okay, just a benefit. I think it's very important information because I know a lot of you guys, you're struggling to do deals on because of there's how do I say it? I mean, most of, and Bill may or may not agree, I don't want to speak for him, but I would say there's a large amount of very bad information that is sold out there in the marketplace in the form of real estate courses that doesn't even delve into a lot of probably anything that we just talked about, quite frankly.
Oh yeah. Most of the real estate courses, they might teach a concept, but I don't know of any that cover tax consequences, which can be very significant as we kind of demonstrated.
Yeah. Well, listen, and let me just say this, okay? In this particular situation, a lack of understanding of taxation can mean the difference between me and the joint venture partner of we get $37,000 or we don't. Okay. So for me, it's very important to understand all this stuff because, that's a, nice little lick, if you know what I'm saying, for a couple of phone calls and sending some contracts out. All right. So for those of you that are on here or that watch the replay or listen to the podcast, you never stop learning. I mean, never stop learning. Okay. You constantly continue to educate yourself on this kind of stuff because it can make the difference. That one little thing that he was hung up on about not being able to write off the expenses that he didn't have anyway could have killed the entire deal. And a lot of people would not have been able to explain it to him that you don't have those expenses anymore. So there's nothing to write off. You don't have to worry about writing off something that you're paying because you're not paying it anymore. Okay. All right. So pros of owner financing: make the property easier to sell. That is absolutely 110% correct. And the reason that's the case is because how we can sell a property right now. All it is, to do a deal on an owner finance deal, you need three things. So I have it on the website. You need a buyer, a seller, and a contract, and that is it.
Yep.
That's all it takes to get a wire. Okay. Profit is usually greater. Okay, on an owner finance transaction. Well, let me give you an example. And this is a slide Bill put together. He hit the nail right on the head, because when in talking to the seller, again, retiree on fixed income, and he's looking at this as, okay, and he actually asked me this question. He's like, okay, so when we do this thing and they finally refinance and pay off, do I owe you any kind of fees, right? Because what he's looking at in the back of his mind is, if I do this deal, I don't have to pay 6% in realtor fees, right? And I told him, no, I'm not licensed, and you don't ever pay me a dime. Okay. Now he doesn't know, and he was totally actually fine with it. He's like, I don't know where you're making your money, but it's fine with me, because I'm not the one paying it. And I said, yeah, it's not a philanthropy, it's a business, so I'm definitely making money. So I'll be upfront about that. I don't have a problem telling people that. But, in his mind, he's looking at, okay, how can I increase my net income while at the same time minimizing or eliminating additional expenses? Because in his situation, 6% on 515, it's over 30 grand right off the top. Okay, that he would eat on a conventional sale, whereas we do this deal. Well, and let's qualify that, because it's that plus. I had to explain to him on January 1st, if these people move out, you're making a $2,000 payment. How many months will you be making a $2,000 payment until the property sells? And then how many months can you afford to make a $2,000 a month payment on the property? And what if it doesn't sell? Then what? Right? And, they don't extrapolate these things out. They're thinking about that. They're just thinking, okay, the realtor's telling him that there's impairment or impediment with the showings because there are tenants in the property, and that's why we need to go ahead and get them out. So the realtor is thinking self-serving, like I'll be able to show the property more if I get the people out of the property, right? Not taking into consideration the fact that the retiree is not going to get to eat $2,000 a month with no guarantee. And, that they had some, we actually got in this conversation too. They had, the deal was, because I always ask for plan B, like, okay, if the house doesn't sell, what's plan B, right? And the reason I do this is because I want to walk them. Number one, I want to make the mental connection that there's a high potential that the house may not sell. Okay. And if that doesn't happen, what are you going to do? Most sellers have never had that thought, because when they put a property up for sale, they're only thinking about the property selling. They're not thinking about the property not selling and, what they're going to do to back up and punt. So I want to make that mental connection up front. Say, okay, look, if the property doesn't sell, what's plan B? And then I shut up. It's called the silent close. And you let them talk. He's like, well, if the property doesn't sell, then he's with one of those real estate brokerages that they guarantee to buy the house. Okay. And I said, okay, well, did you read the fine print on what the percentage is? I said, because, typically somewhere in the 60 to 70% range, which obviously, once again, it's 30% off the top, or roughly 30% off the top of 515. There is equity, right?
Yeah.
It's gone at that point.
And Vincent?
Yeah.
If I could just interject here, if somebody tells me that they're with a real estate company that guarantees that they will buy the property, or if they sell it, what they actually do, right?
Well,
all they do,
yeah.
No, all they do is make the payments until they can sell the property to a buyer.
Oh, really?
And that's what I explained to the owner. I said, well, hell, I can do that. Yeah, I can make your payment. I can make your payments until you find a buyer, and I'm much easier to deal with than that real estate agent. Never mind. I digress. But a lot of people don't realize that.
I honestly didn't know that. I didn't know that's what they were doing.
Yeah, if you
How do
if
they-
you yeah, if you read the fine print in some of those contracts, and I can't say that every single one does that, right?
Okay.
But that's what most of them do. They just agree to make the payments on the property. They don't pay for that property. They just make the payments on the property until they can sell it to a qualified buyer.
Well, it's a smart strategy. I'll
Sure
hand
it
it
is.
to them.
That's what the home relocation, back in the day, the home relocation people said that we'll buy your property if we can't sell it. It's essentially the same thing, but they're just making the payments on them. And I say I do the same thing. I'll make the payments on it until I can get a buyer in there and get them refinanced and cash you out.
That's beautiful, guys. If you guys didn't take away any other nugget from this, there you go. That was a big one. I didn't know that. So fantastic. That's fantastic to know, because it's the same exact thing. There's no difference.
Yeah, that's what we're doing.
Except for we can pay more.
Right.
Yeah, because I think you said, I don't know if it's true or not, but I think you said that they were, somewhere in the high 70s, as far as the percentage that they would pay of appraised value. So, but still, nonetheless, that's 20 something plus percent. That's over $100,000 that he's losing by going that route, plus the $2,000 a month he's going to eat until the property sells, which we don't know how long that's going to be either. So, all right. So next up, installment sale method can be used for taxes. We covered that already. Absolute pro of owner financing, which means that the capital gains or the portion thereof is only realized on a monthly basis based on what portion of that payment is an actual gain on sale. All right. Property with potential title problems can be sold. This is I'm glad you put this in here, Bill, because I get this stuff all the time, and people ask, these especially these quote unquote wholesalers or whatever. You guys are used to dealing with this kind of stuff. I have never once, and I'm going to explain this to you why. On any owner finance deal, I've never once pulled title when we did the deal and sold the property to the buyer. Okay, not once. And people are like, oh my God, why didn't you pull the title? Why didn't you get an appraisal? All this kind of stuff, because it's totally worthless at this point in time. All right. And there are other reasons for that, because the purchase contract with the seller says that the seller will provide clear and marketable title. Okay. Well, if the seller is going to provide clear and marketable title, right, and there's nothing I can do, or even Bill, as much as he knows, there's nothing he can do to shield the property from any additional liens between now and the time that the buyer refinances. What's the benefit of pulling title? The seller's already said and put in writing that he's guaranteeing a clear and marketable title. I can't stop somebody from filing a mechanics lien. Okay. The only thing that you can do, which is probably highly advisable in many situations, is you can put a clause in the contract that the seller can't refinance and pull out more equity. You can do that, but that doesn't impact the title. I mean, the title right now, it could have a bunch of different title defects, but it doesn't make a difference to us today because we're not qualified for financing today. Okay. And then the only time it becomes important is at the time that the buyer is qualified for conventional financing. It's the same thing with an appraisal. If you guys do an owner finance deal, and people ask me this all the time, like, well, okay, should we get an appraisal? And we go, like, you're buying a property, so you can do all of the conventional things that people do when they go through a conventional sale. You can get an appraisal if you want to. You're paying for it, not me. Okay, just like you would if you went out and bought a house through a realtor. You can get, you can have the title pulled and get a chain of title from a title company. You're paying for it, not me, right? And you can have the property inspected if you want to. Okay. And in, the last 13 years, I've never had anybody get an appraisal. I've never had anybody pull title, even though they could, and they weren't prohibited from doing it. And I've only had one person on one deal do an inspection, and that's because we knew of it was like a $575,000 house on a golf course in Atlanta, and we knew that there was a water leak because there was water leaking into finished basement. And so they paid for an inspection and found out that there was a problem with the irrigation system, and they had to dig up, ended up costing about $3,000 that the seller paid for. But they ended up having to dig up the irrigation system, or a portion of it anyway, and fix the leak, and then everything was fine. But all that stuff is totally unnecessary. That's why when we talk about Bill in Johnson City, Tennessee, can start literally with nothing today. Doesn't have a property, doesn't have a buyer, has nothing, and can do a deal. Right? He gets one piece of the equation. I advise going buyer first, but maybe he finds a great property, deal. Maybe he goes inventory first. You can market that property. You can sell that property today and get a wire today. This is one of the fastest methods that I'm aware of to make money in real estate investing, because you don't have all the red tape that you have to deal with, because we're not waiting on title companies. We're not waiting on appraisers. We're not waiting on inspections. We don't have all these other third parties involved. It's simple. It can be as simple as a conversation with a buyer, a conversation with a seller, and then putting the agreements together and getting a wire. And I have done that many times same day. Doesn't always happen same day, okay? But it can happen same day. So there you go. Problems with title can be solved. Whereas, if any of you guys watched that Facebook Live I did the other day, I turned it into a podcast. I think I put it up. Maybe I didn't. Where it was from Investopedia. I'm going to find it real quick. Just so you guys can see some of the bad information that's out there. If I can get back to it or not. Okay, so this is from Investopedia, and they go on here, and I totally dissected this thing and showed all of the errors that are in this article from this quote unquote authority, Investopedia. Okay, and, stupid stuff like this. Don't expect better terms than with a mortgage. I don't know, it makes no sense to me. Okay, 20% down payment. Okay, that's most people don't have 20% to put down, and you don't need to have 20% to put down to do these things. There's a thing in here. I'm just going to find it real quick. And then they go over. Okay, so this is their advice. Confirm the seller is free to finance the sale, and they go into the due on sale clause and getting a title search and all that stuff, which is totally worthless. Here goes the due on sale clause boogeyman. Okay, and as you go through all this stuff, this is why it's very important to do your due diligence, people. Okay, and don't rely on stuff like this, because this article is just loaded with all kinds of nonsense that doesn't really apply. Okay, there's inaccuracies. There's a lot of stuff that is accurate, but there's a lot of stuff in here that is not accurate as it relates to that. And they're talking about you need to get title and all this other stuff, and there's no reason for that.
Hey, Vincent, did they include the one that says that you can't sell your property if there's a mortgage on it with owner financing?
Yeah, it's right here.
Yeah.
I covered that. Hang on a second.
That's really kind of an interesting one, I think. That I don't know where they come up with this.
Yeah. Okay. Confirm the seller. Here it is right here. Confirm the seller is free to finance the sale. Seller financing is simplest when the seller owns the property outright. That's not true. A mortgage held on the property introduces extra complications. That's not true. Paying for a title search on the property will confirm that it's accurately described in the deed and is free from a mortgage or tax liens. Well,
yeah. Tax liens don't matter either.
Yeah, I know. That's my whole point. Okay.
It's crazy. I had a seller tell me one time that he couldn't sell his property because he had a mortgage on it, and it's illegal to sell a property with a mortgage on it without telling the lender.
Yeah, no, and I think they said actually, I don't think they actually covered that in here as far as telling the lender or whatever. But Bill brings up a great point. All right, you're not required to tell the lender anything. And the one thing I cover with this, because people get hung up on this nonsense about the due on sale clause, is and I've been doing this for over 30 years. I have never once met anybody that has had a note accelerated based on the due on sale clause because of a title transfer. Okay.
No,
And
I haven't either. It's always something dumb that the seller did.
yeah, exactly. And the only time I've ever seen a note accelerated is because people weren't making payments, and has nothing to do with due on sale.
Right.
That's a lis
Right.
pendens filing for a foreclosure because you're not, you're in default. And go ahead.
There is actually a Supreme Court case that says that it is not illegal to transfer a property without telling the lender. There is no obligation on the part of the borrower to tell the lender that a property has been transferred.
Are you able to find that for me where that's at?
I will see if I can't dig up the case.
Yeah, I'd love to have
There
that.
is one.
If you, yeah, I was not aware of that, but I'd love to see it. Now, let me clarify what Bill and I are talking about here real quick, just so that there's no misunderstanding. We are not suggesting to do anything fraudulent whatsoever, okay? But you're not required, as he just indicated, and I guess there's a use of the Supreme Court case that verifies this. You're not required to tell the lender that you're doing a title transfer, whether you're doing a contract or deed or a land contract or doing a wraparound mortgage on a subject to, whatever. You're not required to tell the lender anything, okay? You have nothing to do with the lender anyway, unless you're doing a wrap and you want to get, scoop the escrow money and or get the payoff on the property and that kind of thing through your borrower's authorization or authorization to release information. But the lenders do not care who is making the payments on the property. The lenders are in the interest collection business, okay? They don't care if Bill is making the payment on the property or I'm making the payment on the property, okay? They don't. It just doesn't matter. As long as the payment comes in, that's all they care about, all right? They don't care who it is making the payment as long as the payment gets made. The only time that you run into a problem is when the payment doesn't get made. Then you got a problem, okay?
Correct.
So
Yes.
don't think that, number one, because I see this, people are like, they're always afraid of all this stuff. Oh, I gotta tell the lender this. You don't have to. I mean, you can if you want to. And the easiest way to do that, if you're concerned about something, is to simply, and you guys don't understand the law, okay? Under the law, okay, and pay attention so you understand what I'm saying. Silence is acquiescence, okay? What does that mean? In English, what that means is if you don't object or contest to something that you have, some piece of information that you have been provided, okay, a precedent is set, and that then becomes the de facto standard terms of service, contractual terms under which that deal is going to be done. And I'll give you an example of how it works. Every single one of you has accounts with God only knows how many people that you're paying on a monthly basis, whether it's your cell phone company, your electric bill company, or whoever. And how often do you get an email from them? Oh, we're changing our terms of service. Okay. And there was I wish I could find it. I'll see if I can find it. There's a guy he's a wise guy up in New York that went in his credit card company because he understood silence is acquiescence, right? I mean, silence is if you're silent, it means you agree. You're acquiescing to what he says. And so they were sending him a change in terms of service, and he sent them back an affidavit with a change in the terms of service that his credit line was going to be increased to like $100,000, and the terms were going to be at 0% interest. Okay, well, guess what happened? The credit card company never responded. They never contested what he said, and when he didn't pay them, they took him to court. And when they took him to court, he brought up the affidavit, which by the law, if you guys understand, affidavit is the law, unless another affidavit is filed contesting every single point and proving that every single point that is in the original affidavit. That's the way the law works. And the credit card company ended up losing. Okay. And so this guy ends up with this $100,000 credit card at 0% interest because he understood that silence is acquiescence, and he said that. So if you're concerned about a lender, let me back up. If you're concerned that you would be doing something illegal or fraudulent by not notifying the lender, then the easiest thing to do is just send them an affidavit and let them know what you're doing, and then move on down the road. Because you're talking about multi-billion-dollar institutions, and it's going to end up, no offense to anybody on here, but it's going to end up with somebody making $15 an hour who's not going to have any idea what it is to begin with, and it's not going to go anywhere. Okay, does that hopefully that makes sense to you. Okay, it's just not going to happen. So you can notify them, but nothing's going to come of it, and they don't care anyway. Now, the other point that I like to make on the due on sale clause thing is this, because everybody's all panicked about this whole, we're doing something the contract says we're not supposed to do. Well, the analogy that I've always used for, I don't know, probably 2 decades now is that there are a bunch of other clauses in the mortgage, in the note that you sign, okay, that you also violate. One of them, and this is the easiest one for people to understand, is that you agree not to bring any hazardous chemicals into the property. Okay, there is actually a clause in the contract that you sign when you buy a home in the mortgage that you will not be bringing in any hazardous chemicals. Well, what's the very first thing that you do when you move into a house? You're bringing in Clorox, you're bringing in Drano, you're bringing in, you got gasoline and WD-40 and oil and all kinds of stuff in the garage. You got all the detergent. I mean, you have enough stuff to make a bomb in your laundry room. Okay, that's the very first thing that everybody does. But your contract, okay, your mortgage says that you can't do those things, but you do them anyway. And you're not worried about that clause, but you're worried about the due on sale clause, which to me is ridiculous. But anyway, that's I don't know where the hell we were at, but that's all right. Cons of owner financing, loss of rental income / expenses. All right.
Let me throw something out here. When we look at these pros and cons,
sure.
Okay, what some people consider a pro to other people might be a con. What some people consider cons might be to someone else, a pro. Because, I mean, as far as your situation was concerned with this seller, loss of rental income and expenses were absolutely not a con.
No, that's pro for him.
To owner financing, right? Yeah. However, if you are a real estate investor that is active in doing a lot of properties and things like that, it's good to have rental properties on occasion, because that keeps some of your other properties from becoming flips. Okay, right. Because you're establishing investment intent. So guys, when we're throwing some of this stuff out, let us stipulate, and give a caveat that you've got to look at your individual situation. Because in some cases, having rental properties is a good thing if we're very active investors, right? Whether we hold them long-term or short-term, it's good to have properties that are being held for rent, because that establishes our investment intent. So when you look at these, don't think that, oh my gosh, if I get rid, or if I do owner financing, then I'm losing all of these rental income and losses, right? So don't think that's always a con. These are sometimes deal specific. So you got to look at the entire situation and analyze each deal on its own basis. But in this particular deal, and one of the cons that people will throw out to you, as Vincent indicated when he was talking with this seller, oh, I'll lose all my income. I'll lose all my deductions, right? Well, that's kind of crap. Okay. Yeah. Because what a lot of people don't realize, all these deductions and things like that don't really save that much on taxes. They think I'm losing my tax write-off. Don't forget that we are limited to a $10,000 loss on passive income, right?
Right.
In other words, the only thing we can use as a loss on passive income is $10,000. Guys, a $10,000 deduction on at someone at the highest tax bracket, which might be roughly 40%. Okay, that means they're only saving $4,000 on taxes. My Lord, you can get a $4,000 deduction by making a contribution to an IRA.
There you go.
Okay, so people think that they're getting all these write-offs with rental properties. That's not the biggest advantage of having rental property. I
Well,
digress.
you know what? And you can even fine, and you can even roll into the tax deductibility of education.
Yes.
Go ahead, tell them. I mean,
As far as
well, as far as
I missed part of what you said.
Well, yeah, the tax deductibility of education.
Okay.
Okay, so is it or is it not accurate that if someone buys your course, attends your mastermind, whatever it is, that they can write that off?
Oh, that yes, it is. That is correct.
Okay, so there's in other words, there's many ways to make up what
That you can get other tax deductions. Yes.
Right, exactly. Okay. All right, and so then the other con of owner financing, and this actually is a con, or it can be, is cash is tied up in the paper. All right.
Correct.
Now,
Yes.
for me personally, I'd always prefer liquidity. All right. I'm not a fan of equity in properties ever. I've done, webinar after webinar on, equity is the enemy of investors, because basically all equity is, and if you guys don't understand what equity is, the definition is it's the difference between the value of the property and how much you owe on it. The reason I don't like equity in a property is multifold. One is it's nothing other than an insurance policy for the lender. Period. End of story. That's all it is. Okay. People like to argue, oh, I want to pay all this stuff down and whatever. All you're doing with each payment that you make, each principal payment that you make on a mortgage, all you're doing is you're increasing your taxes, you're increasing your risk, okay? Because all that equity is 100% at risk, as everybody found out in 2008, especially people in California and Arizona and Florida. And just to put that in proper perspective, at that time when all that was going down, I had a lease option deal that this is a personal deal on a house I was actually living in. It was a $2.5 million house at the time that I did the lease option, running me $12,000 a month. And when the quote unquote crash happened a year later, that same house was going for $960,000. Okay. So, the person that I had the lease option with had $500,000 down in the property, okay, which is gone, overnight. So there's a lot of reasons I'm not a fan of equity. I prefer to have things leveraged to the hill. The other thing is that equity is a phenomenal attractor of attorneys. Okay. And I see people that don't have their assets shielded properly. And where they, and sometimes it's in real estate investing, sometimes it's unavoidable to have equity because, the lenders want 20% down, generally speaking. Not always, but most of the time, if you're going to go out and buy an investment property, they want 20% cash down. If you're going to do that, my advice would be to, utilize what's called OPM or other people's money and, pay the premium to the private lender, let them make their money. You have less risk because you don't have any cash in the deal. I've never once personally put money down on any deal in 30 years and wouldn't, for all the reasons that we're talking about right now. Because once again, like Bill says, cash is tied up, in the paper. And unfortunately, that cash is 100% at risk. And, it's not a good thing. Right now, people have the other argument. Well, eventually I'll have the leasings paid off and there'll be cash flowing and all that stuff. Well, you're still at risk though, because, there are horror stories after horror stories after horror stories on the internet about, little old ladies, who paid their property taxes and they owed like $6.37, because of some fee on the property taxes, and ended up getting foreclosed on a house that's paid off. Okay. I posted that like 4 years ago. And so, you got to be really, really careful on having these things shielded. I'm not, like I said, I'm not a fan. Bill may have a different opinion. I don't know. I'm not a fan of equity in a property. If it's going to be equity, I would prefer it to be, I'd rather go ahead and bite the bullet, pay the points, and have a private lender make his money, let him assume the risk and the liability, so that I don't have to deal with that. And I want to maintain liquidity because, as many people found out, you can't eat equity and you can't pay your bills with equity. And you could have paid on a property for 27 years and missed repayments, and all of a sudden the lender's coming after you to foreclose. And well, guess what happens to your equity at that point? It's not a good thing. Okay. And I got an epic battle. All right. Peggy Bean asked the question, is this also applicable to lease options? I'm sorry, I don't know what slide we were on when you asked that. So if you're still on, if you could clarify for us what you're referring to, we'll be happy to answer that. Other than that, I think we have gone like way longer than I thought. But
Yeah. Dude, don't start me talking about taxes, right?
Yeah, well, see, I knew it. And we just we wound you up and gave you an audience. And
you exactly did. You when you asked me to be on this webinar, you had me at taxes.
All right. Pros of lease options. You still hold title of the property. Okay. You retain all the tax benefits. Higher sales price. This is all true. Option fees. Again, this is a beautiful one. Most people don't know this. Option fees are not taxable until the option is exercised or expires, or the term I use is or abandoned. And what that means is that if you do a lease option, and before you do lease options, before you buy into this whole do lease options on every friggin' deal that's out there, I highly advise you listen to the podcast episodes I've done on this, because they're really only, in my opinion, 2 times to do lease options. Okay. It's not a one size fits all deal. And I've done tons of lease options. Okay. I've done them for houses I personally lived in, like I just told you, multiple times. And I've also done them on, for lack of a better term, the retail side, where we made money off the option fees and the assignments that we were doing. So I am not anti-lease option by any stretch of the imagination. Okay. Having done them personally for myself and having done them as a business and made money. But there's a lot you need to learn about disguised sales and the impact of that. And I'll cover this really briefly. I did a deal with a guy about 3 years ago in San Diego. It was $1 million house. And the guy lived in California. No, I'm sorry. He lived in Hawaii. Properties in California. And he did the standard, what you guys are buying in these stupid lease option courses. He used a standard lease option contract.
Oh, Lord.
Yeah, what ended up happening? No, this guy, look, this guy's a multi-millionaire. We're not talking about some dummy, okay? But, it's like the standard downloadable contract thing, or what you get in these lease option courses. And he had a guy in the property for 5 years, paid on time, everything's great. And all of a sudden, the guy ends up getting divorced. He loses his job, and he stops paying. And so by the time I got involved, the guy had been the tenant had been in the property for 2 years without paying, because the very first thing he did, of course, he couldn't make the payment on the house, but he lawyered up and he could afford an attorney. Well, he got a good attorney. He got a good attorney, and the attorney, knows what Bill and I know about lease option contracts. And the attorney just tore the whole thing apart, and, got into the fact that it was actually a disguised sale from the very beginning. And so how it ultimately ended up is that the, not seller, but technically the seller for me, because I was buying it on a contract to deed. But the landlord ended up getting to pay 2 years worth of payments for this guy to live in the house for free. He got to pay his own attorney's fees. He got to pay the other guy's attorney's fees. And then, because they invoked Dodd-Frank because of the disguised sale aspect, and they were at jeopardy of actually losing the property altogether, which most people don't know about, they actually ended up having to settle with the tenant who wasn't paying and pay him more money to get him out of the house.
Yep.
Okay. So, go ahead.
And here lies the problem. A properly structured lease and option is wonderful. The problem that I see with most of the courses and most of the people who say they're doing lease and options, they're not structured properly.
Correct.
Because
100%.
most people don't know how to structure these.
And that's why you guys need to be careful, okay? Because this guy literally almost lost $1 million house because of the standard vanilla lease option contract that you guys are using every single day. All right. And there's a very specific way they've got to be structured. I cover it in, I don't know what podcast episode it is, but it's covered in a couple different podcast episodes, how to structure them properly. All right. Peggy says, what are the 2 times to do a lease option? Well, we're talking about residential here. Okay. Single family residence lease option. In my personal opinion, the only 2 times are going to be, one is somebody genuinely wants to try before they buy. Okay, maybe they're moving, they don't know if they're going to like the area, the school system, the house, the neighborhood, the whatever, and they may or may not want to buy the property. Okay, they generally want to try before they buy. That's a legitimate time to do a lease option. All right. The other time that I would say is a legitimate time as an investor, and I saw this a lot in Florida back in the late 90s, early 2000s when depreciation was going through the roof. Investors, what they would do is they would do lease option deals on oceanfront vacation rental type properties. And they would either lease them out long term or they would do turn them into vacation rentals. And the objective was because they were getting premiums because it was waterfront and they were cash flowing like a banshee and they're watching the appreciation go through the roof, is if the property appreciated to a certain point, then they would exercise the option and cash out, for literally hundreds of thousands of dollars in a very short period of time. Okay. And that's an investor. That's another legitimate time to do a lease option. What's a time not to do a lease option? Where you market rent to own and the intent is that the buyer wants to buy and you want to sell, and what you actually are creating is a disguised sale. Now, Bill does this on the commercial side, or quote unquote commercial side, for master lease options, and that's not what I'm discussing here. Okay, master lease options for apartments and all stuff, 100% for it, all day, every day, and twice on Sunday. Okay, so but what's being taught in these courses that are out here is to do it on every single family residence that you can find. Okay?
Right.
When you know that the intent is that the buyer wants to buy and your intent is to sell, that is not a time to do a lease option. Okay, just structure it correctly. You can do a land trust. You can do land contracts, installment sales contracts, whatever. This is one of the things that frustrates me. I was going over this the other day. Here in Florida, and you need to check your own states, okay, because every state's obviously different, as Bill indicated earlier. But in Florida, a lot of people, they like to use lease options because what they want to do is illegally create they create a disguise sale. But what they want to do is they want to avoid foreclosure, okay, in the event of a default. So the fallback to that is to do a lease option deal. Well, in Florida, as long as this is the way the law states, as long as the sole intent of a land trust, okay, is not to avoid foreclosure, which, if you understand all of the benefits of a land trust, I don't think there's any better contract out there for real estate, quite frankly. If you understand all the actual benefits of a land trust, it would never be your sole intent to use it to strictly avoid foreclosure. But as long as the sole intent is not to avoid foreclosure, on a land trust in Florida, you can do a land trust. And if the person defaults, you can take them right through the eviction process without having to foreclose. Okay. So again, this is why it's important to continue learning and understand what the laws are in whatever state you're doing a deal in, because otherwise, you miss out on fantastic opportunities. And in this case, I see people doing this all the time on these lease option deals, and I just shake my head because I'm like, it's like, I know everybody's doing it. And the problem is what you don't hear is what happens when things go wrong. Okay. Because they're not out there banging their chest and talking about how wonderful lease options are when that happens. As a matter of fact, Bill, Scott Moyes and I, and Angelo Russo did back, this is what, 2014, 2015.
Yeah, it's been about 4 or 5 years, I think.
Yeah, it's on my podcast. It's one of the, I think, 5 and 6 or 6 and 7, somewhere in there. And Scott went through his entire how he literally lost everything because of an improperly structured lease option deal. And you guys should listen to that so you understand what the problems with that were. And we went through an actual real estate attorney's, and this is a great point. We went through a real estate attorney's contract line by line, and you guys will see him on Facebook. His name's Angelo Russo. Nice guy. Don't get me wrong, but he's a real estate attorney, and he had clauses in his contract that he knew were in, I don't want to say, I don't know if violation is the right term, but that he knew would not
They were
hold up
unenforceable.
unenforceable. Thank you.
They were unenforceable.
Unenforceable in court. Okay. And so when we asked him why he did that, because he knew that it was, I don't want to say illegal, but we use Bill's term unenforceable. The answer was twofold. Okay. This is a real estate attorney. One was, number one, because he didn't believe that the tenants were going to be educated enough to understand that they were unenforceable. And number two, that even if the tenants did understand that, they couldn't afford an attorney to fight in court. Okay. Now, to me, that's not how you do business. Okay. I don't do things that way. If that makes any sense. Right. I want things to be straight up, totally transparent. Everybody know exactly what's going on. And, but that's how that's part of the problem with going to, dealing with attorneys, and people always say, oh, they'll always go to an attorney, whatever. And I'm like, the only attorney you ever want to deal with, as it relates to contracts, everything else, is I cover this over and over and over again, is a real estate litigator, not some guy that's sitting there doing closings all day long for $400. Okay. That's not who you want to review, draft your contracts. You want the guy that's actually duking it out in court as a real estate litigator, because he knows what all the ins and outs and what's going to come up. And when I had my contracts prepared back in 2008, it was actually with a real estate litigator that I was doing a deal on one of his own. He was a real estate investor also on one of his own properties. And what I did was I did three things. One is I said, okay, because we had some clauses in the contract that were designed to help us avoid, on a contract for deed, the necessity and requirement to take the property through foreclosure. Okay. And so I said, look, I love the concept. I said, no, I can sell this like hell all day long, but what I want is the following. I want the contract. I want a letter of opinion on your letterhead stating that what I'm telling, what's in this contract is legit. And I want the backup statutes that show that what we're doing is 100% legit and above board. Okay. As opposed to just, railroading somebody into an eviction when they had equitable interest and all that kind of stuff. Okay. All right. So let's end this up, because me and Guy, we're going to.
Yep.
Bill,
and one thing I'll throw out too, Vincent, is, and this is where you and I probably agree to disagree somewhat, because I do use lease and option deals. I think that there is a place for them, not every deal. And I think that I don't just use them on every deal indiscriminately. Okay. But I think that, there's very successful people who are doing lease and option deals now. And just for instance, I was talking to a seller, and one of his reasons for not selling was COVID. Right. He says, everything's up in the air. I don't know what to do. I don't know whether I should sell this property, blah, blah, blah. And the perfect solution to him, which he okayed very quickly, was, I said, so, okay, I can understand that. So what if I rent this property for X number of years, and then once all this COVID shit is over, I cash you out at your full asking price? Is that something that would work for you? He signed immediately.
Yeah. Beautiful.
Okay. So there are times that I think a lease and option deal is appropriate.
So let's walk through that though. So, but then you're going to do what with that property? You're going to assign that to someone else, or you're going to?
No, I'm going to hold it. Yeah, I'm holding it actually for a rental, because I intend to exercise the option.
Right. Well, that's key. See, that's key right there. Right. Yeah.
So I'm going to exercise the option and then either sell the property with owner financing, which you can't do. Okay. A lot of people I've seen kind of screw this up. They get a property with a lease and option, then they think they can sell it. No, you can't sell that property because you don't have title to it. Right. So I'm going to exercise my option, and then I will either sell or keep it as a rental property.
Right.
But there are times and places that lease and option.
I agree. I totally agree. I'm not anti-lease option. I'm anti the way it's taught.
Right. Oh yeah, definitely. Definitely.
When your only tool is a hammer, everything looks like a nail.
That's right. Yes.
And that's the way it's sold. And I'm not a fan of that, because they, for all the reasons that we've gone through.
And I was sure of that too. I didn't want the impression to be left that you only thought there were two times that to do a lease option. question because I
No,
knew that's not what you meant.
Yeah, well, what you just described is you're an investor. It's totally different what you're doing.
Correct.
I'm talking about these people that are buying these courses that are, again, it's like the wholesalers that I hate to use that term because it's not accurate, but nonetheless, if it doesn't fit into the
Wholesale deal. Yeah.
the wholesale deal model, then they don't do the deal, even though it could be done some other way. It's like everything has to be a wholesale deal, right?
Correct.
And it's,
Yes.
it's the same thing with the way these guys sell these courses on the lease option thing. So it's important to understand the difference. And your situation there, that was a beautiful deal. Okay, you lock the property up, you have the ability to sublet, so you got cash flow, and then you cash the guy out in whatever it was, 5 years, whenever the option expires.
Right.
And that's a slam dunk. So but that's, you have to understand, and I know you do, that's not what being sold out there.
Oh, I totally agree with you on that.
Yeah. Okay. All right. So contract lease options, still a landlord, which tenants and toilets, no thank you. And if not properly structured, can be deemed a disguised sale. We kind of covered all that. If you guys don't know what a disguised sale is, IRS guidelines. If it walks like a duck and talks like a duck, it's a duck. In other words,
It's a duck. Yeah.
It's a duck. Okay. And if the way you're marketing, I don't advise using, I stopped doing this myself years ago. I don't advise utilizing the term rent to own. There is no such thing as a rent to own contract in real estate. It does not exist. Okay. I don't advise using that term. Don't use the term tenant buyer. There's no such thing. It's on a lease option deal. You have a landlord and a tenant on the lease, and you have an optionor and an optionee on the option agreement. That's it. Those are the only two that are out there. Okay. All right. So, Bill, this is a question I want you to answer relating to the deal that I'm talking about here. So, when Mr. Veteran retiree gets his payments and he goes to file his tax returns, okay, where is he reporting the payments on his tax return? Since this is not a lease, it's not Schedule E where he's writing off the expenses and all that stuff. Where does he file those payments?
Okay. In the year of the sale, the sale itself is reported on Form 4797. Okay. The collection of the payments, if any payments are collected in the year of the sale and any payments collected in years thereafter, they're all reported on Form 6252.
Yes, I'm going to pull both of these up so they can see them. 6252.
Yep. 6252 is the installment sale form.
It's frightening that you know these.
And 4797, which you just pulled up, is the report in the year of the sale of the property itself.
Okay. And so ordinary gains and losses. And so he would then, in the year of the sale, for any payments received during that year, he would have to obviously report what portion of that was that was. All right.
There it is on 6252. Yeah.
Gotcha. Okay. One other thing I want you to explain, because I know most people don't know this. We were talking about 1031 exchanges and all that. Explain to them what boot is.
Okay. Boot is the amount of cash that you receive in any deal. And usually you only talk about boot in an exchange. So if you're doing a 1031 exchange and for some odd reason you take cash out, and ordinarily this doesn't happen because the qualified intermediary won't let you take any cash. Okay. But in years past, when the 1031 exchange was not just for real estate, it was the exchange of anything, and people did them on their own. You didn't have to have a qualified intermediary for those types of transactions. Any cash that you pull out of the deal is considered boot, and it is taxable in the year. It has to be reported as gain in the year that you receive it. Yeah,
and it's really, in my opinion, I don't know what your opinion is, but in my opinion, it's something you want to avoid.
Right.
Personally. I think it opens the door to too many potential problems from my perspective. But anyway,
yeah.
All right. So,
and it can mess a 1031 exchange up. So.
Well, exactly. Yeah. That, and then the last thing you want is these guys knocking on your door talking about an audit.
Yeah.
So, all right. Why don't you, let's put your let's put your contact information up here. Thank you for your time today. All right, for those of you who don't know Bill already, definitely want to friend him on Facebook.
Oh, yeah,
Bill
just reach out to
Walston.
me on Facebook. They can
Okay.
reach me at bill@billwalston.com.
All right, and then tell them about your mastermind.
Oh, yeah, I have a mastermind probably that I'm having the first of the year, probably February or so. It's called Build, Promote, Protect. And we're going to talk about how to properly structure your entities, how to promote your real estate business, those types of things. It's one that I have usually once or twice a year.
So for those of you looking for solid, bona fide information, not this guru shill nonsense, from an actual investor who has done everything from single family to commercial to God only knows what else. I don't know all of your holdings. I know a lot of what you've done, but nonetheless, I would definitely highly advise if you can make it to this to do that. Okay.
Yep, it will be
Because-
virtual.
yeah, because
Yeah,
of COVID.
it's going to be virtual. A lot of it is going to talk about how to properly. Vince, I see all the time people who do these LLCs and they either have LegalZoom set them up, or they set them up at Secretary of State's office, and then nothing ever happens with them. Says, "Oh yeah, I'm protected. I've got an LLC." Well, that's crap. They don't know how to set them up. Right? They have to be set up a certain way. They've got to make certain tax elections. The operating agreements have to be structured in a specific way in order to get all the tax advantages. And that's a lot of what I'm going to be talking about at this particular.
You know what? I'm going to do me a favor, and then we're going to end on this because we've gone way over here, and I thank you for your time today. Walk them through the process of quote unquote getting a property or a vehicle or whatever into an LLC. Okay.
Oh, into an LLC?
Yeah, right.
Okay,
Into
sure.
an LLC.
All right. So first you have your LLC, right?
Right.
It needs to be properly structured. But if you're going to put a property into an LLC, if you're going to take it into the LLC when you first are going to buy the property or go under contract with the property, you just got to make sure that all the documents are in the name of the LLC, not in your personal name. The exception of that is the purchase and sales agreement. I don't care what anybody says. I do all my purchase and sale agreements in my own name, and then it's always and or assigns, and then I assign it to whatever entity I want to hold it, right? Because that's the easiest way, because you don't need to show the seller that you're putting it into ABC Trust or ABC LLC, right? They know you, they know who you are, they're comfortable with you. Get the purchase and sale agreement in your own name. If you're going to go straight to a contract for deed or anything like that, that needs to be in the name of the LLC, and then you would sign as member of that LLC.
Gotcha. And as a personal funny aside, one of the reasons I was asking that question was because I don't know if you're familiar with this. My wife runs a number of food recipe websites. She's a best-selling cookbook author and all that. And there's a lot of litigation that's going on which is weird to me. I don't know why. She and I were talking about this the other night, that there's, and people don't understand this. There are food bloggers, okay, like people that run recipe sites that they make millions. I mean, literally make millions, and there's a lot of like ambulance chaser attorneys that are going after them for all kinds of crazy stuff, for non-compliance with I don't know if it's ADA, Americans with Disabilities Act, if their site is if it can't be accessed by people that have vision problems or something like that. I mean, there's all kinds of crazy stuff that's going on.
It's weird, but yeah, I'm familiar with it.
And she says, one of the things that she's like, I need to get these domains into an LLC, so you have have that shielding and have it protected. And I'm like trying to wrap my head around, how do we get a domain into an LLC? How do we do that? And I'm like, it's basically, I don't want to say it's an intangible, but it's somewhat of an intangible. It's not like a house or a car.
Well,
or
actually,
something like that.
yeah. Interestingly enough, you just change the ownership. You go to wherever the domain is registered,
Mm-hmm.
and where it asks for the owner of domain, you put in the name of the LLC,
And that's it.
and that's it.
Beautiful. Well, I appreciate that.
Yep, that's all. Yeah, that's all you'd have to. You
that's
just
really
change the owner. Yeah, you just change the ownership, and it may or may not ask for a contact person. And if it asks for a contact person, then you just put your name. You would still have the LLC
Sure.
protection, but yeah, the name of the domain should be in the name of the LLC.
Gotcha. Okay. Well, I appreciate that. Thank you. Because I'm like, it just, I'm like, who the hell? Like, they're going after food bloggers now? Like, what?
Just got to change the registered owner's name.
Yeah, it was just bizarre. All right. Well, Bill, I cannot thank you enough. This has gone, like I said, way longer than I anticipated, and absolute tons of value that I know I got out of it. I can only imagine what everybody else got out of it. Hopefully, it was beneficial for everybody else. But thank you very much for your time today.
Oh,
I will get you a copy of the video, the recording, the whole 9 yards.
Okay.
For yourself, but it's also going to go up on my stuff and all of that. And for those of you, typically Bill's masterminds are in person, and I forgot about this whole code. But this time he's doing it virtually.
Got to do it virtually this time.
Yeah, I would highly advise those of you that can to do that, because you're going to be getting, rock solid, bona fide, legitimate information, and not this BS these guys promote all over Facebook. Okay.
Hey, by the way, Vincent, that Supreme Court case is Field v. Mans, 1995. The one with the Field v. Mans. And that's the one that says they rule that it's not a fraud to violate the due on sale clause if all you're doing is transferring title to a buyer without telling the lender about it.
Beautiful. All right, I'll pull that up because I'm going to use that for additional content. So thank you for that. All right, guys. Listen, hopefully it's beneficial. Like I said, for those, I don't know what the date of the mastermind is, but I'm sure it'll be out there. I would friend Bill on Facebook and definitely partake in the virtual mastermind if you can, because it will be chock full of even more quality information than what we just went over here, which was really designed to be very simplistic and for the layman. So have a wonderful day. Let's go make some money. You guys have a great day.
Thank you for listening to the Virtual Real Estate Investor Podcast with Vincent Polisi. If you found any value in this podcast, please use our Give to Get method and take a moment to give us a 5-star rating in iTunes and your favorite podcast service, so we can keep giving you excellent episodes of real content you can use to profit today.